everyone, welcome to the Money Storm Show. This is a place of discussion about all things money and how to weather that storm. Without further ado, these are your hosts, Chet and Larry. You have Chaitanya Monga, otherwise known as Chet, the founder of Brightcap Financial, a commercial and alternative mortgage brokerage. You have Larry Heron, founder of City Center Mortgages, a mortgage brokerage which specializes in residential mortgages nationally.
Yeah, so let's get into it, everybody. This is, of course, our first episode. We are super excited. I'm pumped up here with my partner Chet for this podcast. We wanted to talk about what's going on in the market, the financial markets. Touch on little things like that. A big year has passed financially. Of course, 2022 was an interesting year, shocking year, scary year. Opportunistic year late in the year, which we can get into later on, but it was just a big year. I wanted to just touch on a little bit about, of course, mortgage rates. Big news out there. Some of the lenders that are some of their rates, what lenders are offering at the moment right now for everybody, and I wouldn't mind talking a little bit about the stock market as well. So I'll jump into rates first and foremost.
Right.
As we all know, 2022 was a rising rate economy. We were tackling inflation, or not we, the government, the Bank of Canada was tackling inflation, so we all can, be in a healthy economy. So we get what they're doing, but there was a rampage of interest rates, which they had to do, and they've explained why. But that's obviously put people in situations that they might not want to be in, or just a tricky time. So we want to weather that storm and talk about it. Like right now, interest rates, Chet, insured mortgages, so first time buyers, new buyers, people that want to get into their first home, right now interest rates are at like a low that I see here. Insured mortgage, somebody with 5% down can get away with a 5-year fix at 4.74%.
That's pretty crazy there, because we not too long ago we saw rates at 6%, 6.5%, right?
Insured. So this is insured,
rates,
5 years. By the way, this is not like from a big bank or anything. These are called, it's from a mortgage broker exclusive lender. And we can talk more about that later on. But 4.74 5-year fix is what I've seen. I've always said 4%. It's not too bad money.
Yeah.
But locking in at 5 years, I personally, would want to steer away from that. Some of these same lenders, they have 3-year rates, which is better, because I think we're in a temporary high rate economy, and we all want to see it come down. And I think
absolutely
in the GVA, Greater Vancouver, we need the rates to come down. These rates at 5 and 6 just don't make sense with $1 million, $2 million homes.
Yeah. So Larry, let me ask you a question. Right? You see rates across the board. We've seen the 1-year rates, the 2-year rates, the 3-year rates, 4-year rates, and 5-year rates. Now, when we're looking at them, there's a significant difference, like you just had mentioned, right? I think 2-year rates are significantly higher, and 1-year rates are significantly higher than our 5-year rates, significantly lower. So why don't you tell us a little bit about that and kind of what that landscape looks like for these lenders and for the government, and how what they're doing really.
Yeah, I mean what they're doing, right? The $1 million question. I mean, nobody knows what the heck they're doing, right? But I don't even think they know what they're doing. But one thing that stood out to me, Chet, that's an awesome question. One thing that really stood out to me about these rates, and for all the listeners, anybody out there, tune into this part right here. So if you've got something coming up, a renewal, or you're buying a home and you're selecting a term. Variables, Chet asked about fixed products, because quite frankly, variable products aren't too popular right now. I mean, it makes sense for an investor who's going to be an in and out or something like that. But for a buyer who's going to live in their first home, minimum 2 to 5 years, for the most part, they're moving in there more than 5 years.
Right.
But they're taking fixed products. And right now, guys, everyone, fixed products, be cautious. Because what I sense right now from a 1 through 5 year term, the 1 and 2 year terms are popular terms. It's what I'm selling. It's what I personally took just a little while ago.
Right.
I took a 1 year term with a big bank, because these are all-time high rates, right? Well, at least not all-time high rates. I take that back. These are the highest rates we've seen in the last decade, right? We've been coming out of a low-rate environment, a little bit, I would say, spoiled environment, but we came out of the 2% rate. Now we're at 5-6% rates. They knew they had to get out of this 2% area which people are accustomed to, and they really had to get us used to like 4.5% money, which the rest of the world that was already at.
Yeah,
right?
the states have been
like
has
they
been
were
that.
there during the pandemic,
Absolutely.
3.5%.
Yeah.
Right. So they should have just done this, jacked it up a little bit higher sooner.
Yeah.
But it is what it is. So now what's happening is, of course, business is business. These banks, the Bank of Canada, they want to lock people in for as long as they possibly can. I don't think the rates are going to stay this high for the next 3-4 years. So if you take a 5-year fix at 4.94 or 4.74, which is significantly lower than a 1 year at
Right.
5.99,
Right.
Well, uninsured, it's not even being offered, but if you take a 4.74 versus a 5.84 or something, that's a percent. That's a big difference.
That's a big difference.
But people are taking that. I'm taking it. I took it because 12 months from now I get to renew. I just don't think the rates are going to be in the 5-6% range.
Right.
They could be in the same range, and hey, I go another 12 months, but I feel 24 months from now, the rate should level back and get lower than the 4.74, 4.5, or hopefully get back there, right? But that's kind of the justification there. So the
Right.
1-2 year mortgage terms are, I think, great because you get to kind of weather this storm and take it 1 year at a time,
Right.
Opposed to just hanging it up and signing up for 5 years,
Right.
and then halfway through your term, rates are back down to 3.5%, and you're going to be like, man, I should
Right.
have took the 1 year, 2 year term. So
Yeah.
that's my feedback, guys. But
It kind of sounds like the banks want us to lock into those 5-year rates.
yeah, it's like a financial squeeze
Yeah.
play. It's actually common, and that's what's happening. So the financial squeeze, what that means is, let's kind of make the variable 6%, the 1-2 year mortgage terms, which are the short-term mortgages, cheap penalties, cheap to break, early renewals. Let's make them expensive. Let's make them 589, 599. But let's make the 5-year terms super attractive.
Yeah.
Right? So just be watchful of that, everyone. I mean, 4 or 5 years is a long time to tie up, a large investment, your only investment for 4 or 5 years.
Yeah, I think it's an important comment to make that the average mortgage in Canada is about 3.5 years, right? So regardless of what your financial plans are, chances are you are going to break that 5-year term.
Yeah, that's great. Like statistics show, guys, the average Canadian breaks their mortgage. For the average product is a 5-year term, and that 5-year term on average is broken 3.5 years in. So having said that,
Yeah.
don't get sucked in. Oh, the guy is going to tell you, the broker, whoever. I mean, God bless all brokers, right? I mean, brokers are doing it way better than banks, right?
Right.
Because we got options. But just be careful, 5-year terms are scary right now, in my opinion. But sometimes they could make sense, and it all depends. But it's all case by case. But I just wanted to kind of stress that.
Absolutely.
The 1 and 2 year terms are high,
Yeah.
but they might be the best, right?
Yeah, I think you're absolutely right about that. That's what it seems like. It seems that that squeeze play is intact, just in any market. Even in the stock market, like prices are set by the buyers and sellers, and realistically, in this situation, the buyers are us, the sellers are the banks, right? And they're squeezing us to a point where we have to understand that this is their mindset on it, and that's ultimately going to be a better sense of it's going to give us a better sense of the financial direction that most people need to go into. And of course, every situation is different, like you said, right? So if someone's going to be in that house for 5 years, that rate might make sense to them, and they're risk averse, right? So you're absolutely right.
You're right. Everything is like the whole market. It's all sentiment,
Yeah,
and it's all emotion.
absolutely.
People aren't buying a whole lot right now,
Right.
And they're testing the waters with these high rates,
Right.
and they are kind of gathering as many consumers as they can to lock into these 4 or 5 year rates. But to pick up the market, to stimulate it, the rates will hopefully decrease, within, I'm saying this in the next 24 months. It's not like,
Yeah.
rates are going to dramatically drop overnight, but, within
It's-
the next
yeah.
24 months, we should anticipate some
I think what
right, to come down, because
Yeah.
it doesn't make sense with the $1 million
It
market in
doesn't.
Vancouver, right?
It absolutely doesn't. Yeah, I mean, rates won't decrease as significantly or as quickly as the COVID-19 impact had on the market, and rates were significantly dropped. They won't drop in that same way. There's gonna be more balanced market.
Yeah,
They're
those are
gonna
emergency
slowly-
rate cuts, right?
Yeah, exactly.
Unknown pandemic. So
Yeah, so at the end of the day, we need to remember that it's important that all these rates, realistically speaking, they're all attractive, and you just need to make the right decision for you and base it off of that ultimately.
Yeah, absolutely. Now, I mean, you know, I want to get into a little bit of like the investor mind state,
Right.
Because prices have dipped, as we all know. You know, our assessments came out, which we can talk about later. But
Yeah.
February was an all-time high,
Hmm.
right? So, you know, people were buying at that all-time high. Since then, nationally, we've come down 12%. Every market's different. Every pocket's different.
Right.
You know, people are coming back. I mean, I've heard like some developers, investors that are looking at single-family homes. I believe have kind
Right.
of come down the most. You know, like
Yeah.
you know, houses from like South Surrey at like
Yeah.
1.6 are now being bought for 1.3. Cloverdale back
Yeah.
under $1 million.
I mean, the house market itself, the detached home market itself peaked the most, right? So it's only natural for it to come
Yeah. Okay. Yeah,
down
makes
just
sense,
as
yeah.
much, right? So you're absolutely right. I think those are the assets that come down the most, and I feel the same thing. Investors are coming back into the market, and they realize the opportunity that they have to get into the market with prices $200,000, $300,000, $400,000 below at what they were at, and you know, taking a little bit of a higher interest rate to take up the offer, right? And at the end of the day, the interest costs are so significantly low compared to that 400K price decrease,
Yeah.
that it just makes perfect business sense, right?
It does.
To go about it that way.
Yeah, I mean, I kind of ran a little small case scenario with an investor.
Right.
We forecasted with a 4% rate versus a 6% rate, you know, what the payment interest would be over the next 24 months.
Right.
It was nowhere near the $400,000 discount that he felt he was getting on the single family home.
There you go. Yeah.
And, you know, we moved forward.
Right.
He did take a 1-year term with a big bank at 12 months. And, you know, that was awesome. But
Yeah.
more on like, I mean, commercial activity, I guess, Chet.
Yeah.
You know, you're in that space. I know you're super busy right now.
Yeah.
You got some projects on the go.
Right.
But yeah, I mean, I wanted to specifically ask you, where's the developer's mind state at? You know, with the townhome builders, condo builders, or what have you.
Right. You know what? This is an interesting time in the market when it comes to developers, builders, and just investors purely, right? So this market, although we classify it commercial, is strongly dependent on residential market as well, right? Because we've seen these homes that were selling at, you know, peak prices, and they've adjusted, right? So now when builders and developers to go get their financing, they go ahead and get their appraisals completed, those values are no longer the same. So they have to make sure that, you know, they're building at lower cost as well, and they manage those costs well, but at the same time retain those profits. And at the end of the day, they have to sell the prices that are available in the market today, not what those peak prices were, right? So it's a little bit interesting. Developers and builders are back in the market, right? There's a slow introduction. It's not like not everyone's having massive FOMO at this time, but they're slowly getting back into the market, and we see
Back to the drawing boards and number crunching.
that's really what it is, right? That's the
Sounds
stage
like
we're
it.
at. Yeah,
Yeah.
because they're seeing these reduced prices, and
Reduced prices in what respect, like on the land or
on the land, right?
Okay,
Because like again, the single detached home was once again 1.5 benchmark almost, right? And it's come significantly lower if we're just talking about the Surrey market itself, right?
Okay, yeah.
Now when we take a look at that, the prices that these developers are paying for land and so and whatnot has of course adjusted as a result of that as well. So when they see that this opportunity to get into the market at lower price points, they're taking that opportunity, even though it's at a little bit higher interest rates, because they see that the higher price points once again will be tested. And of course, if they're not, that's what they're, and if they're not tested, they're making sure that their cost itself make perfect sense in today's market itself, right? So builders and developers are still a little bit more risk averse right now when it comes to purchasing and developing and building in this market. But as an overall result, like they're coming back into the market as long as the numbers make sense, right? At the end of the day, they're in a business, right? And just how all investors kind of judge their decision based on the rates that you're discussing, the 1 years, 2 years, and 5 years, they're using similar projections to see realistically when this project is going to complete, what they expect rates to be at, and build a understanding based off of that. Just as how we saw in our market, with our trend, like we started off 2022 with peak pricing, right? And mid-year we saw those prices coming down as a result of mortgage rates increasing. So it's the same mindset, right? So if we see the 5-year rates much lower than the 2-year rates or the 1-year rates, builders are building that same mentality into their cost analysis and their profit analysis on these projects, so they can have an understanding of what the market might do. At the end of the day, everyone's speculating, right?
Yeah.
We don't know what happens realistically in the market. We can try to time the market, we can try to study trends, but realistically speaking, there's always multiple different points as to how the market can turn, right? Just like no one expected the COVID pandemic to inflate the market, right? But what happened? It was exactly
land was
that's
running
exactly
out.
what
Not
happened.
a house left was the mentality, right?
Right. So that's really it, right? And people saw these prices climbing from $1 million a rancher to like 1.5, and people are like
1.9 at one point.
1.9 at one point, right? So it's just people
Yeah.
had that fear that they were gonna miss out on something, and
Yeah, I think the pandemic and people, even me, I was like, just get a roof over
right.
our head and families and everyone and stuff like that. So
Yeah.
I think people were buying thinking this is a pandemic. People are unfortunately dying. Is it going to spread? A lot of Hollywood movies out there with world-ending movies and stuff. So I think a lot of that actually plays a factor, and people bought homes like the world was going to end.
Absolutely.
Almost, right?
Yeah.
And that inflated them.
So
Everything badly. Yeah.
Absolutely. So when we talk about builders and developers, that's the mindset that they're using to realistically purchase, build, and develop these properties, right? And that commercial and residential world is kind of connected because, their initial purchase might be commercial, but their end product is residential,
Yeah,
and they have to think about that.
That is so cool. I just had a thought right now.
Yeah.
So a client of yours buys some land,
Right.
building condos, townhomes, or whatnot.
Right.
Your client might take a 2-year, take 2 years to build this out,
Right.
and it's all done.
Right.
They might be in the high rate environment,
Yeah.
and then when they're ready to sell and everything's finished up, if they haven't done pre-sales or whatnot, and now
Right.
they're doing pre-sales, 2 years from now, fast forward, the end buyer might be in a low rate environment.
Absolutely.
And these guys, they might be able to make up for this high holding cost
Right.
with profits, hopefully in a low rate environment. So it
Exactly.
could, developers right now, it's just like a holding thing for 2 years,
Yeah.
but the end user might benefit hopefully in 2 years, right?
That's exactly it, right? Even with builders and developers, it comes down to carrying cost. If someone can afford to hold these high interest payments and hold these higher rates,
So the ones with cash are
the
just
ones
like
with cash,
loving life.
yeah, the guys swimming in cash are the ones that are kings, right? Like
Yeah.
they say, cash is king, right?
Hand picking, right? Let's get that one.
Yeah,
Let's get
exactly,
that one.
exactly. That's really it, right? So builders and developers.
One
like I
day.
said, yeah, one day we'll talk about that. Us doing that as well, right? But like when it comes to the other commercial sectors,
Okay.
right? Let's talk a little bit about your standard industrial units, right? Your retail units. Let's talk about apartment buildings as rentals and things of that nature. Those assets are significantly dependent on rental income being produced, right? Or owner occupied. The business's growth if we're taking a look at that. But let's stay away from that because it's going to get complicated.
For the most part,
For the most
investor.
part. Yeah, from the most part, let's look at
How do we make some money?
Yeah, let's look at the investor mindset. So naturally, all rents through the COVID pandemic and even now have been increasing over time in adjustment of prices increasing as well, and the carrying costs of financing becoming significantly high, right? Those assets are significantly dependent on income being generated from them, right? So when we're taking a look at rising income from these properties, it naturally means that those assets are more stabilized than our residential markets because they don't see the same peaks, they don't see the same decreases. This is almost a more balanced market. I can't say for a fact that they haven't come down in price or they have increased in price because it's dependent on variable factors, right? But realistically speaking, if you take a look at that market altogether, it's more stable because it's focused on the income generated by the product itself, and that's what matters to those investors. So the only challenge of getting into that market right now is the higher rates that we're dealing with. If someone had secured, for example, a commercial asset at a lower rate, say at the beginning of 2022, they're laughing, right? Because their property has appreciated significantly because the rental income has increased, right? And they've locked in that low rate. But the guys today that are trying to buy these assets are paying much more higher carrying costs, right? And that brings a challenge into the market as well, because now they have to throw more cash into it to make that purchase.
If they don't want to have a negative
Right.
output.
That's really it. But at the end of the day, when we look at it from the point of what the carrying cost is and what the rental income is, like those guys as well, they're taking a speculative look from that 1 to 5 year span and seeing, okay, if I go ahead and purchase this asset at this price point, in the next year, 2 year, 3 years, when can I expect lower rates? And they're waiting for that, right? Because most of these guys are again jumping into 1-2 year terms, hoping for that low rate to come in.
Which is quite common. Like
Yeah.
on the residential side,
Right.
as you know, the most popular mortgage product for the average Canadian consumer is a 5-year fixed.
Right.
How about on the commercial side? I think is there a popular product? It's all case by case.
It's all case by case. It really depends on everyone's needs when they expect to be, because most of the guys on the commercial side are all investors, right? So they're all thinking from the investment landscape, and they're looking at, okay, when am I going to exit this? Realistically, what do I expect rates to be at that time? And they're building their plans accordingly, right? Whether you're a commercial or a builder, you're going to base it off of that, right? And if you're purchasing a cash flowing commercial asset, you're not going to really look at that. You're going to look at the fact whether you have positive cash flow and realistically how much principal pay down you can get from your loan itself, right?
Well, I guess I should have rephrased my question. If somebody was going to buy an office unit, like I'm going to rent it out and I'm keeping this for the long haul,
Right.
then they might consider a 1 through 5 and stuff.
Absolutely,
like that.
they would do the exact same thing.
If it's a long-term investor.
If it's a long-term investor, right? And right now rates have been decreasing, like you've been talking about. Fixed rates on the residential side and the commercial side are very similar at the end of the day, right? Commercial tends to be just a little bit higher. There's a built-in premium, but realistically, the 1-2 year rates are much higher than those 5 year rates still.
On the commercial side
On the
as well.
commercial side as well.
So they got that financial squeeze play over there as well.
Absolutely, that's across the board, right? And we can't do anything about that, unfortunately.
Like over here, I've got a popular credit union which I like to use as a benchmark. It's Vancity. It's public knowledge. Their 1 year is 5.99, 2 years 5.84, and then the 5 year is 5.54. So you got 5.99, 5.84, 5.54 for
Right.
5 years.
Mm-hmm.
That's those 40, 0.5%. 1 year versus 5 just doesn't make any sense. But
Yeah.
how is it gonna on that side?
It's very similar, right? Again, we don't get rate sheets like we do on the residential side, so it's a little bit difficult.
So nothing
to
on
say.
the hour daily.
Nothing on the hour daily, right? It's more case by case basis, more so based on the client's personal profile and multiple different things that we're doing. So it's all very case by case basis.
Oh, okay. So there's like specific pricing.
Exactly. Yeah. So
So a
the
top-notch
lenders,
client, high net worth client gets the best deal.
they would get the better pricing naturally, just because their portfolio is much stronger, right? And it takes a while to get to that level, and of course think about it from that metric, but we can't say that there's a massive interest rate spread between high net worth clients and guys that are just getting into the market.
Okay.
Right? It's not
Okay.
so significant where it's a deal breaker for anyone new into the market. There's still just as much profit. There might be small discounts available, but at the end of the day, if you have your personal profile is stronger, it just motivates the lender to give you better pricing. Just like on the residential side, right? You know how we have beacon tiers and stuff like that on
Yeah.
credit scores.
Yes,
It's the
yeah.
same idea, right? But here we take a more qualitative look at the personal profile of the client.
Gotcha.
And the
yeah,
lenders
like
will
somebody with
base it off
a
of
bruised credit on the residential
Exactly,
side.
exactly.
Credit score might be here. You get this rate here, this
Right.
rate.
And then on the
Gotcha.
commercial side, it's just not as tiered, right? That's the
Okay.
only way you can look at it, but it's all case by case, right? So, but yeah, I think we're starting to run short on time
Yeah,
here, so
yeah.
we got a little bit too into it for the first
Yeah.
episode, got a little excited, but
A lot of mortgage talk, a lot of rate talk, but I want to thank all the viewers and listeners for tuning in. Chet and I decided to get on and just help everybody, educate you guys as much as we possibly can during this time, right? So that's what I want to do, and hopefully achieve that goal.
yeah, and we'll be back with more episodes, so feel free to like, comment, subscribe, and stay connected, and feel free to reach out to us if there's anything else we can help you guys out with.
Yes, and on that note, guys, please remember, everything discussed during these episodes is not financial advice, just information to educate the consumer, drawn from our personal and business experiences. If you have any specific questions about your financial situation, please contact Brightcap Financial or City Center Mortgages. Contact info can be found in the description below.
Great, thank you so much, guys.
Thanks, guys.